Hello, everybody. Thank you all for joining us today. Really excited. We'll have Samantha LaDuc on here. We're going to talk to her a little bit about her process, how she trades, what she's looking at on the macro front, how that macro front helps to translate down to the basics of how she implements trades. And most interestingly, from my perspective, is she brings the options world into this framework. And so I'm really curious to see how she does that. So Samantha, hello, how are you doing?
Happy summer.
That's right. Happy summer to you too. What area of the country are you in?
North of Boston.
Oh, okay. Oh, you're Northeast. Okay. So we'll kick it off here, Samantha. If you could tell us a little bit about yourself, LaDucTrading, just give us a little bit of background on who you are and what LaDucTrading is.
I'm happy to. Well, first of all, I've been a longtime fan of SpotGamma. In fact, I have a few members of my team. We're kind of like, we're power users of SpotGamma. So
Oh, I love to hear that. That's great.
And early on, I mean, before you became, big and famous and all that jazz. So we've been referring your business your way because we absolutely use it every single day. So I actually have a little soundbite toward the end of how my team members use SpotGamma. So stick around for that because
that's awesome. I love to hear that.
They're very specific on how and what they look for, whether it be trading butterflies or gamma levels. But anyway, we're big fans. So who am I in LaDucTrading? And by the way, when I say, it's because I do have a team of contributors. So I'm definitely the lead market strategist, chief market timer. And basically my focus is very much on spotting major macro trends early and then test to see how they're doing. And then also, obviously, putting together some macro trades behind that, which are very much focused on, rates, dollar and oil, for example, but it also influences solidly my take on the direction of market. So as it relates to market timing, I need to know top down, market, then sector, then individual stocks. So I'm very much using that process, and option market structure plays a huge part in identifying the strength or weakness of a particular trend. So I'm all about that. So that's basically how I have morphed from macro to micro, is that I'm using macro as a backdrop, translating kind of complex market structure data. I'm not a sweeper or flow person that is individually interested. No, I'm looking at aggregate. I'm looking at big money flow. I'm looking at places where people are not actually looking and how the options are being structured. And then thinking about the big money. What are they buying? When do they have to diversify, de-risk? Because right now they're full up, right? So we'll get to that. So anyway, this is my translation of the macro and the market structure into tradable sector rotation themes. So I call it basket fishing. But the long and the short of it is I'm following that money flow so that I can see where they're rotating. And then it just goes from one sector to the next. And then I identify the best momentum stocks within that sector. We trade those until they rotate to the next. And in lieu of sector rotation, there will be volatility. So I've become known as a volatility trader, but I do not trade VIX. I am using volatility as a very big input to determine the direction and the strength, the intensity, if you will, of a directional market move and sector move and stock move. So I'm using volatility to help clients position before the move. It's all about getting in before the move. I want to just kind of qualify that. I don't care specifically about trading VIX every single day. I care about whether they're selling or buying puts and calls within that structure on aggregate to be able to better time that kind of pinning action that basically has allowed us to grind higher and higher and higher. And right now we're at an inflection point, which is really exciting that we're kind of doing this talk all at the same time. So in a nutshell, LaDucTrading is very much all time frames and all asset classes. So I have a team of contributors from literally macro hedge fund manager to those who are chasing on a very short duration intraday. And these contributors are, they're totally in the zone of focusing on what they do best. And mine is interpreting the direction and the intensity and the duration of a market move so that we can swim with the current versus against it. So that's why I'm like all asset classes, cross asset, all time frames, what I call chase, swing, and trend time frames. Chase is, a few days to a week, a few weeks. Swing is a few weeks to a few months. Obviously, if it's working, you just keep rolling. And then trend is a few months to a few years. years. So that's basically my interpretation of my time frame, but everyone has a different interpretation of time frame. So, I just want to clarify that because so much can be avoided in conflict on Twitter and elsewhere. If you just define your bloody time frame, don't assume mine because it's your window. Anyway, I get off on that.
I'm with you. I have a love-hate relationship with that Twitter thing. And
I know, and it's so funny because I spend my days, I run a live trading room every single day for clients, and I'm preventing them, from going off the rails sometimes, but most of the time it's just sharing my market views. And then I drill down and write, detailed macro analysis. I set up, all the trades and post those, and then I do custom engagement. I'm not on Twitter very much, but it's kind of funny how whenever there is a mention of, a trade, they're like, time frame. It's all about time frame.
Yeah.
So that's basically it. I use macro as a backdrop, and inflection points basically kind of that I find are intermarket. And that's not something that's really talked about, or even it's a little bit technical, but it's not. It's actually how to compare and contrast asset classes so you can see where you have strength and weakness, right? So that's my job, is I want to identify when money will rotate, and I can see the sector rotation happening before through pattern recognition and intermarket analysis and using macro. So that's an area of focus. I can kind of show you some charts that would kind of, I think, identify a little bit better what the heck do you mean by intermarket analysis, because most people assume macro is all that you need. And I think that is sometimes too little too late. And it's also a little bit unsatisfying, right? When the macro backdrop might be bearish, but the price action is so bullish, and they haven't combined it with market structure, and that's your wheelhouse, right? So they use SpotGamma to kind of test their thesis around macro and compare and contrast if they're on the right side of the trend or not. So I like to do both.
I wonder too, I have a love-hate relationship with the macro side of things, because I feel like there's so much liquidity out there, and the rates are all changing so fast. That's very hard to forecast. Maybe I'm really wrong about that, but it's hard to sort of have a longer term forecast and stick to it. Like, the banks break one day and then they change rates, and then jobs drop, and the interest rates, expectations just change so rapidly. And it feels like all that happens much faster now. And I think Pal had kind of mentioned something about that. So I feel much safer. My point is, in the shorter term structure, where I can see this is where people are buying and this is where people are selling, and it's easier to forecast with that, in a lot of my respects. So I'm anxious to hear how you
I do it a little
navigate that framework.
Yeah, so I understand why so many are short duration, right? Obviously, we know that the zero DTE crowd, largely hedge fund imbued, and they don't have margin requirements. So it makes a lot of sense to kind of pile into that trade over time. And it has worked beautifully, right? Nomura did that study, and, selling puts at the money has been the best tactic out there. So the point is, this has been a recent phenomenon, and you stay on top of those types of moves, right? And that is your great value add at SpotGamma. There's no question. Your daily narrative, but also identifying when you smell it first, but you use data to support it. I think on the macro side, or the trading side, the difference is that I typically start in a zoomed out fashion and then zoom in. So even in my live trading room, you're not ever going to see me on a 5-minute chart, even 15-minute chart. And I know that's like scary. No, you must not be a day trader. Bull. I use a 1 hour and a daily and a weekly. The weekly, for me, this time frame congruence happens to show the early signs of patterns. And then it kind of opens up. So I kind of think of it as the grandparent is the weekly, the parent is the daily, and the hour is the child. The child can move around viciously, right? Yeah. The parent might say, no, not so fast, but the grandparent has the authority. That grandparent literally says whether to go or stop. So I can very much use that as a much, much stronger conviction of whether that short duration trade will have legs or not. So anyway, that's kind of the difference. I'm not focused on one particular time frame. I'm using it much more holistically when we're talking about technicals anyway.
I love that approach. So I have my notes up here. Your notes were much more detailed than mine. Thank you very much for adding those in there.
That's me.
So let's start to look at your macro outline, because as you said, it's this interesting point. I think, I personally feel like maybe we're due for a little consolidation here, but it's unclear to me, looking kind of month to month as I do, that this may end. I mean, Tesla and Netflix weren't too hot today, but I was also trying to put my finger on a few things. The dollar seemed to really drop rather precipitously here, and I saw that you make a couple of mentions of that in your notes. Over the last couple of days, it seemed like there was a lot of FX movement, and anytime you see those dollar drops, assets tend to really rip. And sometimes I bring this up because I have a sense that there's some exogenous flow coming in, and it doesn't always sync with what I'm seeing, right? It seems like something else is pushing things along.
That's so funny, because yesterday, Craig, who is our macro advisor, edge manager, and we do this every 2 weeks for clients, and it's our macro edge, webinar, and we're literally on the same page as you right now. So when this 10-year, and I had already written about this, right? I had already said prior that when we tag and get above 3.9% in the 10-year, there will be volatility. Now, the question, of course, is, does it stick around and reprice everything? But the point is, we will have it. So we got there. We rose almost all the way to 4.1% before the, mysterious, I call it stealth QE and US dollar swaps with Bank of Japan. But the point is that the plunge protection team came in, and exactly then they hammered down the 10-year, I mean, precipitously with the dollar in a 3 sigma move, right? That 5 to 6 days of unrelenting, but it was exactly happened to be, in this macro already, 145 being the top for the dollar yen. So the 145 was literally, it was waiting for that to tag with USD JPY, expecting a rollover, did not expect a forced unwind, but based on that macro environment. Now, again, there's macro, and then there's also, swing and other types of stock and sector rotation. But in this particular case, when the 10-year popped above 3.9, we had that burst of volatility. It was a one-day wonder of 21%, but the point is it entered, right? And then we had the dollar fall very strongly for 5-6 days. We broke the 100, and the dollar yen perfectly tagged 145, which was absolutely, I'm on that. Like I track that every single day, 10 times a day. So this is a coordinated, for me, I'm getting to a point where the dollar yen falls, the dollar falls, right? And then what pops up is your very, very strong yen plus oil plus bonds and gold. They're all very, very related. So that's basically a macro basket trade that I present to clients and lay out and say, okay, this is where I'm expecting the dollar yen to roll over, and that should provide a nice counter trend bounce for yen and gold and bonds, right? So now it's in digestion mode. I have some charts that are kind of gonna infer a lot of inflection coming in post FOMC. Big moves coming in yen, in dollar, in even the Indian rupiah. So that is going to carry over, in my humble opinion, into volatility into markets. But I know you're not studying necessarily FX, but FX volatility is a big mover of equities. So, the interesting thing that was divergence with this most recent forced unwind. I mean, that yen move was sharp, right? And the dollar move was sharp. That forced unwind had something very, very particular happen. Usually commodities and yields travel together when there's no QE. So the fact that they went completely inverse is a sign for me, again, that's the intermarket stuff that I do, that there was a stealth QE, that there was a US dollar swap system going on with Bank of Japan probably or elsewhere. But the point is that will, by the way, because I track that will reverse in the near future. So they will have to send that on back, and we will have some volatility here. So I'm of this opinion where we're at some inflection points, and we've got some FX volatility coming our way post FOMC. So I'm here for that.
Yeah. The volatility makes me so much happier. That's the stuff where it's like you just sit there and every day something just grinds. I get bored. But I watch these things happen. I was just realizing, like, my approach is almost the opposite. Like, I watch the options market and I watch what's trading, and And my partner Matt got mad at me because I wrote, I think on Friday on Twitter, I was like, this is ridiculous because
Oh, it was
whatever's
a great
happening is
line.
just punching out of the punching out. It's like over, the equity market felt like it's over its skis based on the options data. And then I start looking around for macro stuff that you could say, okay, this may be why, right? Because I'm not going to sit here and explain why why
Do
the
you want to know
dollar matters.
why?
But
Okay, can I share? Go to your question, but I want to share the macro why, at least in my best efforts to
please, yeah.
explain the macro why. And I'm not talking about the forced unwind, right, with the yen and dollar and the moves that obviously supported higher equities. And right now, obviously, they're bouncing. And guess what? The dollar's bouncing and equities are under pressure, not just Tesla and Netflix and Taiwan Semiconductor, by the way. But the point is, we are in this macro backdrop that I wrote a lot about for clients this week. So can I kind of show you something real quick?
Yeah, please do.
I know you don't care about macro, but in a way you
No,
do.
I care about macro. I get dragged into a lot of macro conversations where I go, I'm not really sure about that one. So I love talking to people like you. You understand this, and I learn a lot. I learn a lot of things to check out, and I also love how to fit it into my sort of process. By the way, and let me just interject real quick.
Yeah.
If anyone has questions on here, the reason you're all here to ask some questions. So if you got them, pop them in the chat, and then when appropriate, we will take those questions.
Okay. All right. So this was, macro outline. So I'm just going to kind of go through my thinking and then the supportive data, and clients can do with this as they want. But obviously, I'm using this as a place to then create some macro event-driven trades. So in any case, wage inflation is not done going up. Period. End of point. That's a strong contention of mine. In fact, back in October of 2021. I made this client post, and I also later made it publicly available, where deflation of wages ended with COVID. So the whole premise of that was that wage growth would start to outrun productivity, which, by the way, that very large sized outperformance in productivity over wages over 40 years was very beneficial to bonds. So my whole concept, and it was that we're going to flip upside down, that productivity would fall relative to the wage increase, and that would be very negative to bonds. Now, this was something I was already on. I hadn't come up with this like out of the blue. In August of 2020, I had written, bonds are done going up. Now, fast forward, October of 2021, I'm like, bonds are really at risk. 2022, guess what happened? We had the most historic bond crash in history, and it just worked. So now fast forward, right? October 2022, we get a major global bank, central bank intervention of mass size, Bank of Japan, China, Swiss National Bank, Treasury Fed, the whole thing. And they came in September, October, and infused what was later counted at 1.5 trillion in liquidity by Matt King of Citibank. But at the time, we just knew that the dollar yen stopped going up at 152, started to roll over, and that was the end of the 10-year and the dollar advance. Dixie was at 114.75 and the 10-year was at 4.33. They came in, they hit it. They attacked aggressively, and guess what? Equities have been going up ever since. So fast forward to what is going on right now. I just kind of like, what's a durable theme? Inflation is entrenched. So I'm a big inflationista. Even though deflation impulse from last June, right, of 2022 to 2021 to what year are we in? 2022 to 2023, we had a lovely CPI deflation impulse from 9.1, and we just broke the 5 handle into 4, right? So now everyone's like, okay, inflation's gone. Oh, no, it is not. Right. There's nothing deflationary about our backdrop. We have too much money, which means too few jobs, too many asset bubbles, just no. So anyway, inflation is entrenched. I posted that long thread on Twitter one time, 15 charts. I am completely, convinced also that Fed rate hikes are inflationary, and I've got a very strong, long diatribe on that. Anyway, but wage inflation delayed recession. So we're getting to the kind of the macro point. Everyone was like, we're gonna have a recession, we're gonna have a recession. And I don't really call recessions. That's not, I look for the risks. And I use that word, it will put at some point, and I know that what I'm looking for, we will have recession risk pulled forward. And I use that repeatedly with clients and on Twitter. So wage inflation, in my humble opinion, delayed recession. So basically, this was all my premise. and it kind of goes into supporting detail. But the point is, wage inflation begets wage inflation. So we're now, even anecdotally, city mandated living wages are going up. Michigan just passed prevailing wage laws, which, obviously anyone who does contract work with the government has to now pay higher rates. And then all the private companies have to, increase their rates to try and compete. So there's nothing about the labor market that has been recession worthy, right? Labor construction is still in a huge deficit, and that makes up 15% of our lovely economic backdrop. So the trend is still higher. Demographics, we got boomers who retired. They left 2 million en masse during COVID. They're not coming back, and even more are leaving. Millennials are not picking up the space for those construction jobs, by the way. Immigration took a big hit under Trump. Birth rate continues to go down since 2008. I can go on and on with the data. This is not on Twitter. But the point is, we have this now outperformance of wages to productivity. And now I'm going to go through it a little bit further. For the first time, this is, all the data. We'll get to that. Okay, now pay raises are finally beating inflation after 2 years of falling behind. Wages rise more than 4% while consumer prices increase 3%. So that brings me to kind of like the three phases, forget all this, timing the three phases of wage inflation, okay? And why this matters for recession risk, and why I say wage inflation delayed recession. So the bears, the macro bears, they'll get their time, but they were too eager. Okay, stage one, 2020, 2021, inflation growth beats wage growth. That's what actually triggered a lot of the macro bears. They're looking at the worry of consumer spending and not being able to, beat this inflation beast, right? And, debt and credit and all the stuff that macro wonks need to look at, right? Manufacturing and services, I could go on. But the point is, you can always pick an opinion and then use the facts to support it. My point was inflation growth beat wage growth. So there were a lot of worries. But then 2022 to 23, guess what? Wage gains play catch up to inflation. What does that mean? More income, more spending, more demand, more inflation, but it lags terribly. So then you kind of go now fast forward, not very fast, but 2024 to 2025, you've got this, sorry, I should probably put a key or something while I'm talking, but wage price spiral fears will start to trigger worry of pulling forward recession risk and more Fed rate hikes. Right now we're on a pause regime, right? We did our nice stepping up to the mountain. We're now plateaued. Everyone's expecting we're going to go right back down. They're not really totally focused on this wage inflation as very, very, very sticky and lagging and not going away. But that is when we start to have more of the corporate earnings reflect the problem in jobs. So even Taiwan Semiconductor this morning, they gave weaker guidance, but they also said they're delaying that plant in Arizona. Why? Higher costs, and they can't find the workers. So we have a money problem that has created a job problem. Anyway, this is where we get into recession watch. Again, this is my macro backdrop. It's fun to think about these intellectually. It's fun to write about them for clients and engage, but really the money is made in trading. So I'm going to go through this so we can get into kind of the option structure, but this is what forms the backdrop for me. And recession watch, as far as I can tell, good news, right? 2023 has indeed seen decelerating CPI and stabilizing prices, right? Wage, also that whole kind of rate normalization, but continued strong wage gains, which triggered the transition from nominal to real activity growth. That is macro speak for it delayed the recession. So the intermission right now, 2024 coming up, higher nominal wages are going to translate to higher real income gains, which still kind of translates to higher demand and higher equity prices, I believe, so long as demand can save the credit market. So this is kind of down here. Intermission, right, is about 2024. And then we're going to get into 2025. And that's where I think we're going to have the perfect storm. The perfect storm is where we basically have threatened wage price spiral. At the same time, the Fed comes in to hike again and pulls forward not just the recession risk, but more tighter policy, obviously, comes hand in hand at a time where demand will now be really stretched and credit conditions. Corporations will start to show it. So I think this is why I'm kind of tracking, hourly wages, yields, unemployment rate, jobless claims. I have very specific levels that I look for, but this is definitely on its way to becoming a narrative later, right? So we don't have wage price spiral in the news right now. We have, we delayed recession, but at some point we're gonna get there. That make a little sense on the macro backdrop?
Yeah, I think it makes a lot of sense to me. Also, kind of curious in your take. I mean, from my kind of naive vantage point, it still seems that like fiscal and monetary policy just does not align at all. And there's several other macroeconomists who say like there's so much spending on the government side with infrastructure bill and all sorts of new plans there that it's going to be extra hard to get inflation down because these two forces are really kind of competing. And
100%, we have too much money. It's too much money in the system. So
and more is coming online, right?
So that's also creating the jobs problem. Yeah, the whole thing is just more rate hikes equal higher wages, equal higher income and spending. They also equal this, whole inflation cycle. The Fed is trapped. So it might not be priced in right now, but I think very much as inflation right now is troughing, equity prices are, can I do this in this? Okay,
yeah, that's it.
Okay, so I'm doing it mirror here. Anyway, in the same way that I said we're going to have waves of inflation peaks and equity bottoms, that was last year. Now we have an inflation trough, really, and an equity peak. So we're going to have waves of this, but the market is forward looking. It's pricing in the fact that we delayed. We dodged a bullet. It wasn't as bad as feared. Wages are still increasing, which helps that whole corporate structure pass on higher prices with higher prices. That will have a tipping point, but we're not there yet.
And when you inflation adjust the S&P 500, I think it's actually down on the year.
Oh God, and we have concentration risk, which we have to talk about for sure.
Stead here says that you should be on the Macro Avengers. That's a podcast that Imran Laka puts out with Darius Dale. I don't know if you know those fellas.
I know those fellas.
We'll have to submit your name. You can take my spot there because you're much more, so much more. There's a better audience for you to converse with than me. That's for sure.
Well, I'm kind of like a I don't know, odd man out in that I do this macro. For the the intellectual pursuit of figuring out where the economy is going, so that I can pull it back and in my interpretation, right? It's my read, where I can then kind of look at the stock market and say, okay, so what are big funds going to do?
Right.
Where are they going to allocate? The paid to wait was a great theme, right? Why take the risk? Then that global, literally coordinated central bank intervention that happened in October was brilliant. Then we had the January effect, which is seasonal. Then we had the March bailout, and it was a bailout, call it a backstop. But literally, Fed, Treasury, and White House all came in and said, you get a car, and you get a car, and you get a car. So everybody was basically, having their unrealized losses now made whole at par. It's crazy liquidity in the system. And yes, then if they have a bump in the road, they will print. But it is definitely a bigger worry now. And here's why, because it's going to hit the dollar. This in time is very deflationary for the dollar. This is the Druckenmiller playbook. And short term, the equity market is going, yeehaw.
Yeah.
Guess what? They're not going to say it in a year's time. But for right now, this is a tradable backdrop. We also had, as you know, from sector rotation, which is my wheelhouse, we had this after the March bailout, literally on the lows, right? We had all things loose monetary policy, assets that were loose monetary based, just pop up like daisies. We had gold, hot fire flames. We had Bitcoin, we had NASDAQ. So after a while, they started to kind of calm down. And what took over, because that concentration risk was so massive in the mega 8, was a nice little rotation into junior tech. And that was May 1st. And then we had a beautiful rotation that I deemed on June 1st. I got it pre-market, stalking value rotation. And that was literally when the market started to broaden out. So instead of volatility entering, we had sector rotation. So they didn't necessarily lighten up on mega cap tech, but they had other things to buy. And then that value rotation triggered that very famous, right, hedge fund factor sector rotation, where they are massively short junk and massively long the VIP stocks. And then it flipped and they went, oh shit. And they started covering. And that short covering begets short covering. And by the way, that's exactly, once we've run through this sequence, this is not my first rodeo. Once we've run through this sequence, that's when volatility starts to enter. In lieu of sector rotation, there will be volatility. So that's how I kind of process the macro and then the sector rotation, because within the sector rotation, there's your tradable themes, right? I mean, oh my God, junior tech was amazing. The oversold plays were amazing. The value rotation has been amazing. So that's where I make my bread and butter.
And I, hearing you frame it in slightly different ways, you could see the aggressive call buying and all that action in early kind of June, right? When call skews got just insane and NVIDIA and all the AI stories were playing up. And you could see all those get too expensive. And then you could see people turn and go for a look for like, okay, what can we squeeze next? You can just see it play it. And I was looking at a chart of ARK yesterday. I mean, it's getting crushed today. But I was looking at a chart yesterday. And I was like, it's like $55. Like, when did that happen? You know, it's just, it's amazing how fast. I've been phrasing it as the vector of attack, right? Like, where can we focus our weapons, our call buying weapons next?
But that was also a really tradable pattern. So all of these trades, for me anyway, to be kind of high probability, high conviction, is they have to actually have a sector rotation turn. They have to have the money flow. Then they have to have a pattern that can be high, probability of continuation. And then they have to have the option flow, behind it. So one of my, tools, it was early on kind of going to the top 10 shorted stocks on IBKR, immediately said, I'm in. So, a Carvana and Coin. Oh, it's been a beautiful run, but you also need to kind of understand this doesn't happen all the time. There are periods where they are a forced unwind. And when you see it come in, it has nothing to do with fundamentals. It has nothing to do with macro. It has, nothing to do with dollar, yet nothing. It has to do with a forced unwind of those shorts that have been very, very profitable, and they need to take it out. They need to get out. So ride it until it ends. It kind of reminds me of a post that I put on equal weighted. So let me see if I can show this.
Yeah, if you got someone to bring up, please do.
Yeah. So pre-market, I did this rant for clients on June 1st, and it was called Stalking a Value Rotation. Now, this was a write-up that I had done basically the same day, but you can kind of see where I'm going. Okay, listen, 10 stocks represent 97% increase for the market this year. This is just way oversold. IWM is basically at 2008 lows relative to SPY. I see signs of a turn. Here's some very unusual option activity, right? We got the Divi ETF. Anyway, these were some very large out of play. I'm talking about, they usually have like 53 contracts. So we had some really big forced selling that was basically my view, and Mosaic and small caps and IWV, which basically is the Russell 3000. It was one of those deals where it just looked, again, in lieu of sector rotation, there will be volatility. So I think they're going to go and create that lovely backdrop for a rotation into small caps. I also posted this kind of cheeky intermarket, which is basically 5 stocks versus the S&P. Guess what? Small caps tend to beat the big caps coming out of recessions and bear markets. Falling year-over-year inflation tends to be the best backdrop for small caps. So I was in this on June 1st for clients. Like, this was a really strong theme, and I just kept with it, kept hammering it, kept with it. Recently, I noticed something also that was very cool. Let me just kind of see if this shows up. All right, so this is NASDAQ equal weight, right? So again, I'm always looking, where's the big money going to flow next? Where do we put our money? Whether it be a chase, a swing, or a trend time frame, whether it be macro for institutions or micro for the retail traders, I don't care. I want to know where the money's going. Yep. So NASDAQ 100, when was this? A few weeks ago. Okay, equal weighted. It is apparently, so let me do this. There we go. This is equal weighted. It's one of the equal weighted funds. There are several. So I noted there have been major inflows to equal weighted products. And this was actually a Goldman comment. Our macro, I gotta move this, desk is seeing a notable uptick in switching outright pricing requests in equal weight large cap products from both hedge funds and long only investors. Bingo. So I had already been early to the stalking the value rotation. We had already been on the junior tech rally for all of May. By the way, that continued right up until pretty much today. And the short covering stuff obviously picked up in earnest in July. But this is where, you know, folks start to go in after they realize, hey, we got some value rotation that might be a little bit more sticky than sticking with the Qs. So we did have a rebalance, you know, the 100 rebalance is worry. It hasn't actually triggered yet, but it does actually take effect Monday, the 24th, FOMC on the 26th. There's an options expiration. I think there's definitely a continuation theme. My advice to clients, right, was we have this market cap weighted up here. Historically, look at this, 1990 to today, it is extremely an outlier, right? And in my opinion, outliers revert with velocity. So equal weighted is a better place if, you know, there's always a theme. In September, it was paid to wait until this, you know, resolves itself. January, it was a January effect because we got the backdrop of central bank coordinated intervention. March, it's bank bailout. But now as we are approaching this tumultuous, usually August is just a chop fest. Why risk it? Why?
Right. It's been an incredible year. And it's funny about your outliers revert with a lot of volatility. Velocity.
With velocity, yeah. Volatility is different, but velocity is like intensity.
I have volatility in my mind because we've been showing the correlation charts and the put skew charts and all these other, you know, particularly VIX related or put related trades that are the most extreme since 2017. And you go like, this is not the 2017 volatility environment, but we're at that kind of a like extreme, kind of like the chart you just showed. And that's literally what my comments are, is like, I don't know what will trigger this to reverse, but when it does, it's going to be violent or volatile or have a lot of velocity. So,
and it's hard because we have so much money, right? So that it created this inflation, the asset run, and even the jobs problem, and it's not going away. So that's another reason why even these sharp, you know, pullbacks are getting bought. Maybe it lasts 5 days. Recently it was 3 days. You know, maybe today's just one.
Yeah.
I don't think so. I think we're actually at some inflection points. But the point is, it has been still a very supportive backdrop, but we're done. We are priced to perfection. The S&P is now trading, or at least it was yesterday, at 20 times forward earnings. That's just priced to perfection. So as we get some disappointment in these names, it should trigger some profit taking. And that is just basically my experience, is that after we've had this run from the generals, right, back to, you know, dash for trash, we typically get volatility next. How long it's going to last, I'm not quite sure, but I'm definitely seeing lots and lots of signs where we are going to start to peter out and roll over.
Yeah, and I'm with you on that. We've been saying, as everyone here knows, that OPEX tends to lead to a little bit of consolidation, at least when the OPEX have so much call deltas and large call positions expiring. So everybody on this call knows already what my view is there in terms of that consolidation. Paul here asked a question about sort of where are we rotating to. Do you have your crystal ball look into like August to September? You know, whether it's sort of a consolidation versus sort of the topping process. Do you have any sort of anecdotes of things you watch for to say, hey, look, this is the buy to dip opportunity, like values come back in, or this is, you know, we're staying short this market rather than trying to buy a dip?
Let me just show you. Since I mentioned kind of my backdrop is intermarket. I love the macro, there's no question about it, but I'm really, really studying the intermarket to be able to time inflection points. So in this particular case, I've already expressed that my experience has been, once we have this sector rotation into small caps and you know, the oversold, not just the dash for trash, we're going to have a testing period where these plays may need to really, really separate the wheat from the chaff, so to speak. In other words, some of them are going to be durable longs. You know, it's not that all junior tech is going to become irrelevant. Right. Some is just oversold. You know, is Shopify, you know, Amazon in Canada going to go away? I mean, you got to pick your plays and obviously your time frame. But my point was that I literally just said, don't be a piggy. So Monday was, we had some outsized gains, right? And I shared, some of that with you, which has been really incredible on every time frame, chase, swing, and trend, because I had that early thesis of rotation, not just in March, mega cap, junior tech in May, and then most definitely small caps from June 1st, and then dash for trash, right? So that's my thing. I've already said, I think we're going to get volatility. So cut it out. Don't be such a pig. We have to really take care now. And I pointed out, some of your charts, right? Like you've got that 900 as, I think it was your call wall a little while ago. I had already posted my 286.50 for clients a long time ago. So I still expect, right? This has been my kind of level. I got a little bug in here. A little level that would be coming into play, which would be SPX 45.45 and the Qs 386.50. Same kind of area as your 900, right? So I'm like, here, friends support this narrative. So take care, but also take care that you got some ridiculous forward earnings priced into these, mega 10, whatever. Some of them are in the 100th percentile of, relative price to forward earnings, relative to history, I should say, like Apple and Microsoft and NVIDIA and Oracle. Some are still, in my humble opinion, worth holding on to. Adobe, even Amazon. So you got to pick your points. My point is, I try to get in for those who are not just chase and swing, but holding these positions. And then when do you come in and protect with options? Definitely tech flows are getting a little bit whacked here. And that typically is another sign of outflows and revision. But we basically have this situation where, and this is kind of a little sloppy, but here's NASDAQ composite. I can show you on a nice prettier, but we have basically 14,500. That's resistance. We literally tagged it today and came back strongly. So these are levels of inflection that if we can get above, technically speaking, we're in potential melt up territory or continued grind up. But most likely that is where you chop and drop. And that's what I'm absolutely baseline expecting. So these are just kind of warnings, but I mean, it has been a phenomenal past few months of trading, from, Caterpillar to you name it, junior tech, value. I mean, we've had a Nikola junk that was oversold, EV plays. There hasn't been a lack of forward motion. That ended today. I really think that ended today. We're going to get a test here. We might get an overshot, to that, the QQQ9. What the heck, where'd this go? The point is, I think we're definitely, we're testing our luck. We're pushing our luck. We're pushing our luck.
Yeah. I see that from the things I do as well. As I was trying to check the prices here, the recent prices, to see what the market's doing here. And I guess from our perspective, we see multiple names getting these. You start to get call prices where if you just start to do the math, the volatility that has to continue in order for you to get to payoff. You need the market to continue higher to get these calls to pay off. The math on that break even just starts to get so bad that you say they're too expensive. No one can make any money, and that happens kind of in mass. And that's sort of where we're at, this kind of inflection point where all of that stuff needs to kind of cool down. So it's interesting you see this as like this overstretched thing where just when you look at the pricing, a lot of things, you just go like, you can't buy this, it's too expensive. Even if you think that the market's not going to crash, it doesn't mean you can buy this, it's still too expensive. So
this is part of that intermarket. Let me just show you. It's not just a valuation, but I want to bring this up because you put such a good point on something, which is this. Let me share this again. I have, whatever reason, too many bloody charts on my tabs, but here, this is an example when you're talking about valuation and my intermarket.
Yeah, Q's 380 right now. That's what I was looking for.
All right, so we got NASDAQ here to SPX. This is a case of a ratio. Okay, so it's one asset to another, right? One index to another. So I put this on a monthly. Okay, talk about really, who cares? Well, I do, because here's 2000. Right, you can see this melt up that happened, and here's the tippy top back in 2000. Again, this is NASDAQ, not NASDAQ 100, the composite, to SPX. Now, back in here, 2009, QE, guess what? More QE. Anyway, the point is we went straight up post-COVID, right, in the NASDAQ advance, and then we started to form a head and shoulder. Now, at the time, This was November, December. Actually, it was November of 2021. I put a question mark next to this chart because I check this every month. And I'm like, that sure looks like a head and shoulders, which is a reversal pattern for those technical analysts. And I went on TV and I basically said, I think the 13-year outperformance in NASDAQ is done and we're going to have a pullback. And on my price target for SPY is about 20% less at 3,800. And I said that January 9th, but I had already posted this for clients. We sure did. We overshot, actually. We hit like right below 3,600 in SPY. We had a 35% pullback. Obviously, this helped me get in, right? This helped me give conviction and then I could follow it. This happens to be obviously maybe not, but this is, you might not understand that this is central bank liquidity at its finest. We actually came back to a technical level and in October got supported.
Yeah, so is that 3,800? You say that's my target. That's a purely technical call. Do you expect what macro
no, this was
in there, or what's your
No, that was January 9th of 2022 that I expected a 20% pullback. I wrote about it. I had it on TV, the whole thing. And it was in part because all of my intermarket, this is just one chart that I just happened to do recently for clients to kind of show them that we have now, again, we pulled back 35%. And then the central banks came in with that 1.5 trillion in liquidity. We have now rallied into the underside of this trend line. That's what I call an inflection point. So that inflection point tells me we could have a pullback here. Now, maybe we get supported and break higher. Market goes higher, later, end of the year, next year. But the point is, I combine this with a whole bunch of other things. How are semis doing? So here's semis. This is the 2000, right? Same ratio chart. This is 2000 equivalent. And now we've got a head and shoulders potentially forming. Semis are the reason for the season we got into this, move very strongly higher in 2015, 2016. They troughed and they just went and have been very steadily climbing. Now they got the AI. But the point is, if this is now a question mark. So I'll be watching this every month to see if it forms a reversal. And then, just on a weekly, kind of bring this down. Remember that 14,500? Credit, high yield, it has stayed, really. We haven't had any threats from credit stress. But this definitely moved higher, and we're coming right back into a kind of a technical level. Again, NASDAQ, which is just where I expect chop, right? Chop, drop. If we can get and stay above, which, by the way, usually takes a few months, it's not a one and done. If it is, we're in melt up. And if we're in melt up, be careful. Right? So, because parabolas, when they happen, this is not a parabola, not at all. This is a grind higher, but it's not a parabola. When parabolas happen, that's trapped longs. And trapped longs in a parabola will trigger volatility. And volatility will trigger a liquidity event. And liquidity is what makes that, Eiffel Tower look. But that's not what we have right now. We have recession is delayed. Corporations have been able to pass on higher prices with higher prices. Wage earners are making and spending more. Credit is still not stressed. Now, let's watch. Let's see what happens now that we're there. I'm still a big, on oil, not inclined to really get excited about oil. I track gold extremely carefully. I'm right now, this little bounce that we've had in gold because of the dollar yen falling. Right, and again, I'm on a swing time frame. It just tells me that it's an oversold bounce. We're not done going down. So this is bullish percent index for gold miners. So this is all the kind of funky stuff that I use that helps me with clients to say, hey, we just had this really nice, sector rotation in small caps. We're right at resistance area. That's called an inflection point. So protect your longs. Now, again, I'm talking about trend longs, not so much. You get swing longs. They're shorter duration and they're using options that can decay and reverse on them very quickly. So that's the kind of intermarket that I'm doing to help clients kind of figure out where we go next and when it's time to protect. And that's right now.
It's a fascinating and beautiful process to see. So thank you for sharing that and really helping us to break a lot of that down. So what I want to do is sort of pull it forward here. We're Thursday the 20th. We got, you mentioned before, we have the big options expiration next week. We have the Fed coming up and some other things. So as we have a fairly S&P focused group here, I tend to write a lot about that myself. So maybe it's just me that's oftentimes S&P focused. What are you sort of looking at? You want to pull your crystal ball out for the next kind of next couple of weeks, a couple of months for those of us that have a little bit of a short-term time frame, what's sort of your standard
This has to be obviously teased out and tested because it's early, right? So my cap for the S&P this year was 46.60. We're not there yet, right? We hit that 45.45 and the Q's at 386.50, and that's it. I think that's enough. I think if we overshoot, it's going to be a fake breakout and fast failure. I don't think it'll be trustworthy. So we can trade it intraday, we can chase it, but I don't think it's swing worthy. I think there's too much risk for the reward on a swing basis. So basically, that's the cap that I see. And if I'm wrong, by the way, I'll know it, right? I've got my charts on lots of different time frames across assets. I also have my technical analysis, which doesn't suck. And we want to talk about that from a day trading standpoint, because I use your 1 day expected move to give clients S&P price target every day.
So that's great. I love to hear that.
I'm not macro. I'm not just trend and swing. I love the expected move. So you talk about, where's the money flow in the S&P? Because, for trading purposes, I'm looking at it going, okay, CTA levels, what's their trigger for selling? Quant, of course, they're kind of indiscriminate price insensitive buyers and sellers. So, who studies that group best? Gamma levels, you put out great gamma levels. And obviously we have had a very positive gamma backdrop, which a lot of macro folks don't follow as closely, and they should, because they're swimming against the current. And that's one thing I would really just say, you're brilliant. Oh my God, the STIRS market, Euro bonds. I can't even explain it all to me. But if you don't know positive and negative gamma, you're Timex. We've gone digital now. Okay. So anyway, this is, kind of how the team uses SpotGamma, by the way. And I had kind of mentioned that Archana and Michael, they're trading room moderators of mine, and they also post all of their trades, and they're also educating, right? So we do a lot of custom trade support for clients, what if they want to do option tactics, because my job is analysis and client engagement in my trading room and posting all this written and trade levels on everything, but they are actually using your product in very creative ways. So Archana is actually a butterfly trader. So she loves your pinning levels for Friday expiration. So just recently she did an XSP, she had a call butterfly, she spent 30 cents on it, and she closed it, for $1.45.
That's pretty good.
143. So, and Tiffany loves the gamma flip levels, no question about it, for directional swing trading as well. Michael and I both, but especially Michael, he loves this continuing narrative that you use every single day to kind of frame the market risk on, risk off. Okay. And then we actually share that with clients and say, go get your own subscription, so they literally can follow along. But the point is, these indicators that you have created and meshed with TradingView, he uses religiously as well.
Oh, that's great to hear.
Yeah, he does it every morning. And so I actually have my contributors who are, actively analyzing and supporting clients on a shorter duration. So, and they're using, he also uses your hero product. So what I use it for is a little bit different. So I use it as guardrails. I don't want to go off, and I don't want to let clients go too far. So expected move for me is exciting because, first of all, when it moves outside the expected move, typically market makers are going to come back in. So like on a Thursday, we've had an expected move that's too far. Usually Friday, we're going to have some softness. But I don't know if you remember, but a few years ago on Twitter, I did this little, like, I don't know what it was, test. And basically I said, okay, I'm going to call. I haven't done it since, so don't worry. I do it every day for clients, but I'm going to call the exact SPX target high for the day. Like I'm going to tell you the direction. I'm going to tell you the price target. And 3 days in a row, I hit it exactly to the dollar.
Wow.
So it'll never happen again. And I got freaked out about it. It was like, more. They loved that. I do it for clients. So I can use your standard deviation moves with 1 day and 1 week. And I can, with my technical analysis, and again, I'm looking at macro event risk, so I know if we're going to have some volatility, it won't work during those particular weeks, but in the smooth kind of trading weeks, it works like a gem. So anyway, that's how I do it. Basically, like your QQQ with that call wall at 390, right? I think that's a magnet. I've got 386.50, but the same deal, in my NASDAQ composite at 14,500. It's all the same type of magnet. So when I see that you've got some really strong aggregate prints in your strikes, and they happen to also correspond with my technical analysis, it's awesome for a swing trader and to identify when volatility can come in. But for your standard deviation that you compute on a daily and weekly basis, that's for like laser sharp focused SPX targets. And those are a lot of fun for trading.
Well, that's an amazing advertisement. Thank you so much for that. And I would say one of the most interesting things that I've experienced through this many years now of doing this is when people come with a completely different process and they go, when whatever you're saying lines up with whatever I think and see, then I get really excited, and I see that kind of interdisciplinary work kind of mesh. It always seems to line up, and I think it's fascinating as well.
Thank you so much. keep all these new ideas rolling out, and the presentation, the user interface, rolling out, and the dashboard. You've made a lot of improvements, but those are still the core things that I follow. I know you're getting kind of fancy for folks, but
no, well, it's been the zero DT stuff has been particularly interesting, and I don't mean to go off on that side on a side tangent here, but we've had a couple of institutional conversations with some pretty well-known hedge funds recently, and they're inbound calls, and they've been calls along the lines of there are things in the market happening that we can't explain, quantitative type guys, and we're trying to find an answer for it, and that's why the zero DT stuff, why they're interested in it, and I thought that's been interesting because it's been hard to pin down what kind of the intraday effects of those are, and I think the intraday effects have an impact on a larger scale. Like, is it suppressing volatility? Is it allowing people to sell longer dated puts because they're buying short dated calls, and that's what's throwing skew off? Whatever it may be, it's
also the concentration risk. Like you have the massive mega 8, right? So that skew. It's kind of like it's changed. But this is something that you and I could talk about because I have some theories on that.
I'd love to hear them.
I have some theories on that, but we'll do that another time. This is definitely an area where
we did actually hit an hour. I'm surprised.
I know it. We went through an hour, but that's why I'm sensitive to the fact that you got subscribers there.
So I've watched a lot of your YouTube videos recently, and I really enjoyed watching those segments when I was prepping for the interview, just to get a feeling for how you're trading. So I just wanted to recommend people to check out your YouTube channel to watch all of those different flows. In terms of
it's funny. Michael actually takes a few minutes of something that I cover every morning from my trading room and posts it. So he chooses.
Yeah, so it's a nice thing to have. Kudos to Michael.
Yeah. So it doesn't. It might be macro. It might be intermarket. It might be a chase. It might be.
Yeah, I don't know. Well, it's great. You're watching the charts move. You're giving some narrative to it, and it really gives a great feel for different things to watch. How can people find out more about LaDucTrading? Where can they get their subscriptions, or go and check that out? If you want to give a couple seconds on that, it'd be great.
Easy peasy. So I have a new website, thank gosh, coming up in September, but it is LaDucTrading.com, and it will not, that one is so old. My daughter did it, and I just haven't had time to focus on it.
All right.
I do this all day long, but it will highlight also the contributors that half of whom were in fact clients that are now paid contributors. And so this is exciting. I have actually 3 products now because I wanted to be able to serve beginner, intermediate, and advanced. I know that my stuff might be like a little intimidating for beginners. They can, come into the trading room and they can chase to their heart's content, but I really wanted a community that totally nurtures and supports and encourages them at that level where they're at in their trading journey. So I actually created a community product, and it's housed in Discord, and they're mostly young, totally in the zone, very, very good traders. And they totally use different methodologies, mostly technical analysis. They're not doing, the macro fundamental quant stuff, but they might sprinkle that in. But the point is, they're very focused on the chase momentum time frame, right? So that's one product. Mine is definitely intermediate. So I'm going to give everything, and people kind of figure out where they want to swim, chase, swing, or trend. And then if they want the chase, they're going to be in my trading room. If they want to swing, they can have their job and they're going to see it posted, under the swing channel in Slack. And if they want the trends, I've got a great portfolio for that. It's up a huge amount. It's doing really well. And I have folks that help manage these portfolios. So if they, come into a warning zone, right? It's like alert, alert. So
someone's got your
clients are
back.
extremely well protected. The macro edge product is much more macro focused, right? The Darius Dale is really focused on the macro, and that's what Craig is very much about. Pro to pro for those money managers, institutions that are trying to make sense of the event risk and all that alpha beta weighting. So for me, that is a godsend to have him basically take care of being concierge service. I can totally engage with clients doing my kind of secret sauce stuff that spans everything. And then the chasers who want to chase, they go into the Discord product and have at it. So I've got 3 products. It's LaDucTrading.com, LADUC trading.com, and I've got 8 contributors, so full-time contributors.
Holy cow, good for
And
you.
lots and lots of great education, analysis, and trading.
That's awesome. And you are at Samantha LaDuc on Twitter, so make sure you follow over there. Well, I think we're going to end it there as we're up at the top of the hour. I cannot thank you enough for this. It was really fascinating. I learned so much. So thank you very much for that. And hopefully we can do it again in the near future.
My pleasure. Thank you so much. Have a great summer.
Thank you, too.
Bye.